Imagine standing in an apartment leasing office with a signed contract in your hand, only to watch the manager pause and shake their head. They tell you that despite your solid job, your healthy savings account, and your income, your application has been rejected. A silent 360 might lock in a competitive fixed interest rate. A buyer with a score of 6-year duration of that loan, that difference adds up to well over $120,000 in pure interest paid directly to the bank. Car loans follow the exact same financial penalty curve, a top single 5% of your total score, and measures your payment history. Lenders want absolute certainty that you honor financial commitments on time every single month. A single payment that hits 30 days late can drag an excellent score down by 80 to 100. That single late entry remains visible on your credit reports for 7 long years. The practical fix for this bucket is absolute automation across all your credit accounts. Set up automatic minimum payments for every single credit card and loan you own, so an oversight is physically impossible. The second largest bucket makes up 30% of your score and measures your credit utilization ratio. Credit utilization calculates the percentage of your total borrowing limit that you are using at any given moment. If you have a total limit of $10,000 across your cards and carry a balance of $3,000, your utilization ratio is 30%. Keeping your overall and per-free cards open forever, and place a tiny monthly recurring utility payment on them to maintain activity. The final 20% of your score is divided equally between new credit applications and your overall credit mix. 10% depends on new credit, which tracks how many hard credit inquiries hit your file over a short time frame. Every time you formally submit an application for a mortgage, auto loan, or new card, the lender pulls your official credit report. A single inquiry causes a temporary drop of a few. However, applying for 5 different store cards or loans in a single month flags your profile as high risk to underwriting algorithms. The remaining 10% measures your credit mix, evaluating whether you can manage both revolving credit and installment loans. Revolving credit includes items like traditional credit cards, while installment loans include you do not need to take on unnecessary paid interest just to build this category, as a healthy balance develops naturally over time as your financial life matures. Now that you understand the mathematical framework, let us outline 4 practical actions you can execute this week to optimize your profile. First, pull your official credit reports directly from the official central reporting repository established by federal law. You are legally entitled to review your complete reports from Equifax, Experian, and TransUnion completely free of charge. Review every line item with absolute precision, checking for incorrect balances, old collections, or accounts you never opened. Studies by trade commissions show that roughly 1 out of every 5 credit reports contains a material error that unfairly lowers the consumer score. If you spot an inaccurate late payment or an unverified debt, file a formal dispute directly with the credit bureau. The bureau is legally obligated to verify the debt with the original creditor within 30 days, or remove the negative item from your credit report completely. Second, restructure how you execute your monthly credit card payments using the strategic midpoint system. Log into your credit card online accounts and locate both your statement closing date and your payment due date. Set up an automated payment for your main monthly balance 3 business days prior to the statement closing date. This ensures that when the credit bureau snapshots your account, your reported utilization balance remains near 0%. Then keep your automated payment on the actual due date active as a backup to catch any minor remaining balance. This single operational shift can boost a credit score by 20 to 53rd. Systematically request credit limit increases on your existing, fully paid credit cards every 6 to 12 months. Higher total credit limits across your accounts instantly lower your overall credit utilization ratio on future spending. When submitting a credit limit increase request online or over the phone, confirm explicitly that the bank performs a soft credit pull rather than a hard inquiry. A soft credit pull allows the bank to review your account history and income without impacting your credit score by a single. If you maintain a clean payment history and report an updated income, card issuers frequently grant balance increases automatically. Fourth, if you are starting from zero or rebuilding after major financial setbacks, leverage specialized credit brand credit cards at store checkouts just to save 10% on a single purchase. Retail store cards often come with extremely low credit limits, high interest rates, and trigger a hard inquiry on your file. A low-limit card means spending just a few $100s sends your utilization ratio on that account soaring into the red zone. Protect your credit file from unnecessary clutter and focus exclusively on high-standing debt balance. Paying off an installment loan or credit card is a major financial milestone that deserves celebration. However, closing that credit card account immediately after paying it down eliminates available limit and reduces your average account age. Keep the card open, keep the annual fee at zero by downgrading if necessary, and let that history work for you silently in the background. Your credit score is not a metric of your human value, but it is the primary financial lever of modern society. When you take control of this number using systematic, disciplined actions, you stop overpaying for loans, rent, and basic financial services. You transition from reacting defensively to financial decisions to proactively directing your capital toward lasting wealth creation. Review your credit reports today. Set up your automated safety nets, adjust your payment timing, and let the mathematical rules work directly in your favor.